Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a world full of the pundits of pessimism and always that wall of worry. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, you can simply go to www.frossandfross.com and read any of the disclosures that you might find therein. So, despite what you might think, market strength for the year's first quarter has been pretty strong. The S&P 500 is up about 6.5%, while the investment grade bond market is also up about 4.5% since the beginning of the year. Now, that said, we may begin to experience new challenges, unfortunately, as the economy slows and maybe even see a mild recession later this year. So this week, I wanted to talk about 3 signs of an economic slowdown, what they mean, and most importantly, where the silver linings are. So the first sign of a slowing economy is the labor market. Now, what did Ronald Reagan say? He said, when your neighbor's out of a job, it's a recession. When you're out of a job, it's a depression, right? Well, the unemployment rate is still near long-term lows at just 3.6%, and the job market continues to be extremely resilient. We are beginning to see signs of slowing. Payroll reports for March fell well short of the expected new jobs number. We were expecting 250,000 new jobs, and when we got the numbers, they came in at 145,000. Job openings also fell below 10 million for the first time in almost 2 years. Now, what's the silver lining? Well, the silver lining was the report that wage growth, which is the key driver of services inflation and has yet to cool, is beginning finally to level off. This could lower core inflation. The second sign of a slowing economy is manufacturing and services. March data for activity in the manufacturing and services sector also came in well below expectations. This is important because manufacturing and services indexes are pretty good indicators of economic growth. While they are slowing, which may indicate a slowing economy, the prices paid component, another leading indicator of inflation, continued to move lower, which hopefully can help reduce inflation. And then the third one, as you would no doubt expect, would be the housing market. In recent weeks, we've also seen the housing market begin to cool. While rents are still abnormally high, the National Home Price Index continues to moderate, as it has for the last 7 months. In fact, the index came in at 3.8%, which is a low that we haven't seen since before the pandemic. Higher mortgage rates continue to weigh on the housing market and may do so for the foreseeable future, which will add to the atmosphere of economic tightening. At Fross and Fross Wealth Management, we believe these signs point to the probability of a mild recession that may start in the middle of this year. Recent reports in the manufacturing and services, labor, and housing markets seem to confirm this belief. We expect continued volatility despite the rally that we've seen in the market since the beginning of the year. However, we do think that that markets have most likely captured the majority of a pending recession in the bear market that we've experienced over the last 15 months. In other words, the market realizes that the economy is softening and has most likely priced most of it in. Now, the good news is that this year, bond markets have performed rather well after a really crummy performance last year, and hopefully may continue to be the diversification tool that we've historically known them to be. Well, we hope that you have a wonderful couple weeks. Enjoy this cooler weather while it lasts. If you have any questions, please feel free to reach out. Have a wonderful day.